You wouldn't believe just how many people in the last couple of years have woken up to cryptocurrency taking over the internet. In fact, most of these people are now clamoring for a way in, before the governments of the world either ruin the scene by banning it or by joining it. NFTs and DeFi platforms have become much more common talking points, but one of the things people often overlook when considering their next move in the crypto world is liquidity. Most of them are probably watching this right now. So, hello, let's answer these questions. What is a liquidity pool in crypto? Overview. So liquidity refers to a collection that is locked into a smart contract, which itself is a self-executing contract with the terms of an agreement between a buyer and a seller, written directly into the code. Thanks to the nature of blockchain technology, wherein every piece of data concerning a transaction is verified via immense numbers of calculations designed specifically to arrive at the right answer, a process called mining. This means that smart contracts are infallible and can be considered absolutely correct when matters of ownership come into play. What do liquidity pools do? The purpose of a liquidity pool, then, as a big pile of funds that have been allocated for it, is to facilitate transactions over centralized exchange like Binance and Coinbase, and especially decentralized exchanges or DEXs like PancakeSwap. Liquidity pools are effectively a mechanism through which a user can pool their assets in a DEX's smart contracts in order to provide the DEX with enough liquidity for that particular asset or currency, so as to be able to make transactions fast and convenient. Think of it like a cash float in a convenience store's cash register. If you want to buy something and put up the money, but the cash register doesn't have any cash in it, then you can't get your change. But the cash float provides liquidity, which can then be used to complete the transaction. This is effectively a very simple example of what a liquidity pool is. But stay with me here. Before automated market makers, or AMMs, happened, cryptocurrency market liquidity was very challenging for the new DEXs on the Ethereum network. DEXs were a novel concept made with new technology and had a complicated interface and a tiny number of buyers. So those both made it difficult to find many people who were willing to trade regularly. AMMs were able to fix this problem by creating liquidity pools that mean there's no need for middlemen or extra parties. In short, the more liquidity and variety of assets in a liquidity pool, the faster and easier trading becomes on decentralized exchanges. Why are liquidity pools so vital? This won't surprise you, but it's going to be extremely inconvenient to enter any market that has low liquidity, whether it's low-cap cryptocurrency or a huge token like Bitcoin. Slippage is going to be a concern. Now you ask, what is slippage? Slippage is the difference between the price a trade is expected to be traded at and the price when it actually is executed. Slippage happens when the volatility is high, and it can also happen with large orders if there isn't enough volume at the price selected. The market order price is always determined by the bid-ask spread of the order book for any particular trading pair. It's the midway point between what sellers will accept and what buyers will offer. Low liquidity causes longer wait times, and because the prices can go up due to demand, this can mess with the slippage, and the executed trading price can end up being a lot higher than the original market order price. When you trade on platforms like Bancor or Uniswap that have good liquidity pool protocols, there's no need to match buyer and seller, as both can be traded against the total liquidity that is provided by the users to the platform for use in exactly these situations. How do liquidity pools work? Okay, so now we're getting into it. A liquidity pool must be designed so that it incentivizes liquidity providers to stake their assets for the pool. That's why most liquidity providers end up earning the trading fees and get rewarded in more crypto from the exchanges where they pool their tokens. If a user gives a pool some of their assets for liquidity, the provider can often be rewarded with liquidity provider tokens, or LP tokens. LP tokens can be valuable just by themselves, and they can always be used through the entire DeFi space in a lot of different ways. Usually though, A crypto liquidity provider gets their LP tokens as a proportionate measurement against the amount of liquidity they have provided to the pool. And so when a pool facilitates a trade, a small fee is distributed amongst the various LP token holders that aided in the liquidity of that transaction. If the liquidity provider decided that they want to unstake their assets and take back the liquidity they provided, then the LP tokens are destroyed. Liquidity pools help to ensure that the prices stay fair on the markets, thanks to the AMM algorithms that maintain the price of tokens relative to one and another within a pool. Liquidity pools can use various different algorithms, but they basically all perform the same functions with some minor differences. Like, for example, how Uniswap liquidity pools use a constant product formula to ensure price ratios are maintained, and many DEXs use the same or a similar model. The algorithm helps to make sure that a pool is always providing market liquidity by handling the cost and ratio of the various tokens as the quantity requested goes up. What about yield farming? Well, thanks for asking. In order to do their best to ensure the best and most convenient possible trading experience, a lot of protocols will offer even more incentives for users to turn over their assets and create liquidity. What kind of incentives? Well, if you take part in providing liquidity for these incentivized pools as a provider, you are most likely doing it to get the most possible LP tokens. What you are effectively doing is called liquidity mining. And liquidity mining is how crypto exchange liquidity providers can get the most out of their LP token earnings on a particular market or platform. As you probably already know, there are lots and lots of different DeFi markets, platforms, and incentivized liquidity pools that will allow you to earn those rewards for both providing and for mining liquidity via LP tokens. So how does a liquidity provider decide where they want to put their assets? This is exactly where yield farming comes into play. Basically, yield farming is the act of staking or locking up cryptocurrencies with a blockchain protocol to generate tokenized rewards. In essence, you would stake or lock up tokens in a variety of different DeFi applications and then be able to generate tokenized rewards that would help you get the highest earnings. This also helps the crypto exchange liquidity provider to accumulate high returns for only slightly higher risk. Their funds are distributed to trading pairs and incentivized pools with the highest trading fees and LP token payouts. You can even use platforms like Yearn Finance to use its automated system that balances risk versus reward on your choices so that you can get the absolute most out of your choices of liquidity pools. They'll also move your funds to various DeFi investments that provide liquidity. You see, it's actually that easy. Recap. So, as we've learned, in the early phases of the DeFi scene, decentralized exchanges, or DEXs, had a bit of a problem to deal with in that there simply wasn't enough liquidity in the various currencies to make using them convenient for traders. The solution was to add liquidity pools to the paradigm and come up with a system of various incentives in order to get major holders, or whales as they're known, to stake some of their investment into these pools. Liquidity that is generated by these pools helps address the problems of transactions needing matching between buyer and seller, and also taking a long time for the assets to be moved properly. Liquidity pools provided a highly useful, decentralized solution to liquidity in DeFi, and was absolutely instrumental in boosting the potential of the DeFi sector as a whole. Necessity is the mother of all invention, as they say, and liquidity pools might have been born from that need. But the way that they have been set up to benefit and incentivize those who give the liquidity have resulted in a situation where many high rollers would rather stake their assets than just hold them, because that's the simplest way to get a quick return on investment and get one regularly. But what do you think about liquidity pools? And did you understand all of that?